Oil tankers reroute. Stock markets flicker red. Governments call emergency meetings. All of this can happen before a single official speech is even finished. Because in today's world, geopolitics moves markets faster than missiles move through the sky. For decades, the global economy has quietly depended on one fragile assumption: that major energy corridors stay open and regional conflicts remain contained. But when tensions rise around Iran, a country sitting beside one of the most important oil choke points on Earth, that assumption starts to crack. Energy prices don't wait. Investors don't wait. Supply chains don't wait. The shockwaves begin instantly. This isn't just a Middle East story, it's a gas price story, an inflation story, a stock market story, and ultimately a story about how interconnected and exposed the modern world economy really is. When military risk meets energy markets, the result isn't theoretical, it shows up in everyday costs, retirement accounts, and global growth forecasts. Today, let's delve into the story of what happens to the current US economy and the world economy if the US attacks Iran. Don't forget to hit the like button and subscribe, as it is the best way to support this channel. One of the earliest and most powerful economic effects would be on global oil markets. Iran sits near the Strait of Hormuz, a shipping choke point through which nearly 20% of the world's oil supply passes. Even without a full closure, the fear of disruption in that narrow waterway, mined or blockaded, can trigger global price spikes. When the Middle East becomes a flashpoint, markets react quickly. Oil prices jump as traders price in the risk of supply outages. Historical data shows that during Middle East conflicts, prices commonly rise 7 to 14% or more. Higher oil prices immediately raise costs across economies that depend on petroleum, especially the United States, China, Europe, and Japan. Higher energy prices feed into transportation costs, manufacturing, and agriculture, and ultimately show up at the gas pump and in grocery aisles. For example, during the June 2025 Israel-Iran conflict, oil prices initially rose, leading to broader market impacts. Equities slid, airlines faced operational disruption, and volatility spiked. Even a modest disruption, let alone a prolonged conflict, could push prices higher than markets anticipate, widening inflationary pressures rather than alleviating them. The stock market is highly sensitive to geopolitical risk, especially when it intersects with energy. When the possibility of direct US-Iran conflict has been signaled in the past, investors pulled back sharply, with stock indices sliding on jitters. If US forces actually strike Iran, equities likely fall initially as risk assets get sold. Safe haven assets rise, such as the US dollar, gold, and treasury bonds. Emerging market currencies and equities weaken due to risk aversion. Oil-dependent industries face immediate cost pressures. Global markets often react with a knee-jerk risk-off move, selling stocks and buying safe assets before any real economic data comes in. That's because the first casualty of uncertainty is often confidence. A prolonged conflict could prolong volatility, making corporate investment decisions harder and reducing economic growth expectations. One of the most complex effects would be on US inflation and Federal Reserve policy. Rising oil prices, triggered by conflict, directly feed into inflation measures. Higher gasoline and energy costs ripple into goods and services across the economy. But the Federal Reserve, already navigating high price levels and slowing growth, would face a brutal choice: raise rates to fight inflation, which risks tipping the economy into recession. Hold or cut rates to support growth, which risks entrenched inflation and weaker currency. This dilemma, inflation versus growth, is exactly the kind that central banks fear most, and markets may not be prepared for it. Military conflict in the Middle East doesn't happen in isolation. It inevitably affects global trade and supply chains. Higher energy costs increase shipping, manufacturing, and logistics expenses. Companies reliant on lean, low-cost supply chains suddenly face higher operational costs and disruptions. In particular, import and export costs rise, especially for energy-intensive goods. Transportation networks reroute to avoid conflict zones, increasing delivery times and costs. Manufacturers delay investment due to uncertainty, slowing growth. Countries that depend heavily on Middle East energy from Europe to Asia feel these shifts faster than the US alone does. Economists often warn that even small increases in oil prices during conflict act like taxes on consumers and businesses, shrinking disposable income and business spending. Iran's economy is fragile even without war. Years of sanctions, a plunging currency, inflation, and reduced oil export revenue have weakened its fiscal position. For instance, in 2025, during a limited conflict, Iran's oil exports plunged by about 94%, drastically cutting income and damaging infrastructure. A broad US oil strike would exacerbate that situation, likely collapsing production, reinforcing the currency's weakness, and deepening inflation. This means Iran may have fewer resources to sustain long military operations, but also fewer economic levers to restrain escalation short of outright conflict. Iran has openly warned that any attack would be treated as all-out war, suggesting that strikes wouldn't be seen as limited or technical. Retaliation could unfold in several ways. Direct attacks on U.S. assets in the region, proxy engagements via allied militias in Iraq, Syria, Lebanon, and Yemen, drone and missile strikes on shipping or bases. If Iran or its proxies target U.S. interests directly, the conflict could widen, increasing the risks for U.S. service members, allied forces, and global shipping. With Iran's drone capabilities and unconventional tactics, even asymmetric engagements could disrupt operations in the region and add to economic risk. One of the most sensitive economic touchpoints is the Strait of Hormuz, a narrow waterway through which about 20% of global crude oil and LNG trade flows. Iran has historically threatened this route as leverage. While a full closure hasn't occurred, the threat itself affects markets because traders price in the risk that the strait could be mined or contested by military forces. If shipping in the strait were disrupted, oil prices could spike sharply, well beyond already elevated levels. Global inflation would be exacerbated, pressuring consumers and central banks. Supply chain costs for energy-intensive industries would surge. Even a temporary disruption could shock energy markets and slow growth worldwide. Beyond energy, the broader effect is inflationary. Higher energy costs make transportation, food, manufacturing, and construction more expensive almost immediately. Countries with large energy imports, including much of Europe and Asia, would be hit especially hard. Inflation reduces real consumer income, lowers spending power, and often prompts governments to adjust monetary policy. Emerging markets are typically more vulnerable to oil price shocks and geopolitical risk. Capital often flows out of these markets into supposedly safer assets during conflict. As an example, U.S. Treasuries and the dollar. This can lead to currency depreciation in emerging economies, higher borrowing costs, capital flight to developed markets, stalled investment. A U.S.-Iran conflict could therefore accelerate capital withdrawal from smaller economies, slowing global growth. A U.S. military strike on Iran could also reshape global alliances and trade relations. Countries that rely on Middle East energy might deepen cooperation to stabilize supplies. Others might accelerate shifts toward alternative energy sources or new trade routes. Additionally, the conflict could affect how major players like China, Russia, and the European Union calibrate their foreign policies, potentially forming new economic blocs or diplomatic strategies in response to ongoing instability. A U.S. attack on Iran would not be just a military event. It would be an economic shockwave with far-reaching effects. Oil prices spike and inflation rises, global markets wobble and risk assets sell off. Central banks face painful policy trade-offs. Trade costs increase and supply chains strain. Emerging markets weaken and capital flows shift. Global growth slows. These outcomes would not play out evenly or predictably. They would unfold over months and years with feedback loops across markets, currencies, and political alliances. The bottom line is that war is not just a geopolitical actor, it is an economic force. When it intersects with major energy markets and global trade routes, the world economy feels the shock almost immediately. Understanding these dynamics isn't just about geopolitics, it's about preparing for how real people, businesses, and markets might react when uncertainty becomes the new baseline.